Let's get more reaction to this developing uncertainty in the global banking sector. Stephen Glass joins us live now. He's Managing Director and Analyst at Pella Funds Management. He's in Sydney this morning watching all of these market developments. And Stephen, let's begin on this lifeline for Credit Suisse. 50 billion francs being injected, a last-ditch liquidity infusion. Is this a banking crisis, just buying time?
It's certainly a big issue. However, the reason why we would say it may not be a complete banking crisis as yet is this has been a long time coming for Credit Suisse, and in many ways it's idiosyncratic for them. So Credit Suisse and many of the Swiss banks franchise effectively evaporated on 9/11. Since then, they have not been able to maintain the secrecy. That was their whole reason for being. People basically wanted to put their money in those banks, often to avoid taxes or just because they want secrecy for whatever reason it might be. So they were using those banks. Post 9/11, that was no longer the case. So before that date, they basically had guaranteed profits, had this great business model where they basically had stuck money, so they had all those funds where people could not just take it out and spend it elsewhere, which gave them a lower funding cost, which made them very profitable banks. It's very hard not to make money if you're a bank with stuck money. But then after 9/11, that all changed and that money could flow out, and there was really no direct reason for them to try and maintain the same franchise. So of course, what did they do? No one likes to shrink. They took on more risk in order to try and maintain the profits they were used to and keep the salaries that the highly paid bankers were also used to. They took those more risks on, and they've just had a litany of disasters, the most recent being Greensill. Now, the problem with Greensill, it was actually a huge issue because that fund was actually marketed to a whole lot of their high net worth individual clients as a very safe fund, as a way to get yield in a low yield world. And when that blew up, a whole lot of their franchise lost money, and they basically lost trust in Credit Suisse. So here's a bank that no longer had the reason for being privacy, that had also lost the trust of a lot of its high net worth individuals through Greensill, also had a litany of other issues, and basically it shot itself in the foot, and one has to question if it has a reason for being. So yes, this has come at the same time as SVB, and yes, as Signature Bank, and yes, we could see why one might say it's a broader banking crisis. But in actual fact, what we believe is that a lot of those banks actually had a problem with their business model more than there actually being a overt banking crisis. So the contagion, could this result in something broader? Of course it could. No one really knows how these things are going to transpire. But as it stands, would have to say it's banks with real problems with their business models that are having problems, not banks per se.